Hello and welcome to this edition of Know Your 4C Fund Manager series. I have with me today Mr. Nilesh Shah, Managing Director of Kotak Mahindra Asset Management and one of the most sought after voices within this industry. Welcome to this show.
Thank you, Nitin.
Nilesh bhai. Starting with the global markets, we've seen a lot of events unfolding over the last few months. It started with the SVB crisis. Thankfully, that seems to be abating as of now. Having said that, inflation in US still seems to be fairly sticky. It's around 5% and GDP growth rate is struggling. In such an environment, how do you see global growth really behaving?
I think globally things appear a little bit gloomy. The world is addicted to debt. There are countries like UK, Spain, US, Canada, which has to print $3 to $4 of debt in order to generate $1 of GDP. In such a leveraged world, you can't have tight liquidity and high interest rates. Both will kill growth. So unless until central bankers are looking at stagflation, where inflation remains high, growth remains low, I think eventually they'll have to cut interest rates and provide liquidity in order to support the growth. You can't take away this debt addiction of many, many countries.
Right, and considering whatever is happening in there, in the US scheme of things, the Fed rate is obviously expected to come down a little lower from post the SVB crisis. Do you expect interest rates out there to still remain a little bit sticky for too long a period of time?
So my feeling is that Fed will walk left and talk right. They'll continue to tell market that we are going to keep rates higher for longer. But eventually they'll recognize that government debt to GDP ratio in US is 120%. Credit card debt is now exceeding $1 trillion. Student debt is in excess of $1.6 trillion. And mortgage debt is also as high as $11 trillion. In such a leveraged economy, where for incremental $1 of growth you require $3.50 of debt, will you be able to maintain rates higher for longer? Unlikely, unless until you are aiming for deep recession.
Right, right. Now, considering whatever you just mentioned, coming to India, the RBI had a pause last time, and we do not have the inflation concerns that the US has. But we do need to keep some amount of parity between our real rates and what the US has. From an interest rate standpoint, interest rate outlook, also given that there is a borrowing program that the government has, out of which about close to 9 lakh crores is expected to be borrowed in the first half of this fiscal, how do you see the yield curve really behaving, both at the shorter end and the longer end?
So I believe the RBI will not front-run Fed. We will raise interest rates if needed, if Fed ends up raising interest rates too much. And we will be cutting interest rate after Fed has begun the rate cut cycle. This is essentially needed to ensure that Indian rupee and Indian FX reserves remain in an equilibrium position. But assuming that the Fed will start cutting rates somewhere towards mid-2023 to end 23, RBI could be looking to cut rates probably late 23, early 24. In both US as well as India, rate cut decision will be influenced by general election. No government wants, kind of low growth economy while facing election. So my feeling is that right now long duration bonds do provide an attractive opportunity. A large part of what I'm mentioning is already discounted at 7.10 on 10-year yield. But as the borrowing program gathers pace in April, May, June, you may get an opportunity to buy long-term bonds anywhere between 7.25 to 7.5. I think that will be a very, very good level to lock yields.
Right, and when do you actually expect the RBI to start cutting? At what point?
End 23, beginning 24. After they have seen that Fed is firmly on a rate cut cycle,
right,
they'll probably follow that.
Right, and now on debt mutual funds, obviously there is a higher level of taxation, and we have believed that multi-asset solutions, even within debt portfolios, should be part of core allocation. What is your sense on the same?
So while above 3-year investment horizon debt funds tax benefits have been withdrawn, in reality the other benefits of tax which is there, other benefits of debt mutual funds which are there, like anytime liquidity, longest possible duration possible, and on top of it professional management of interest rate volatility. My feeling is that debt mutual funds will continue to play a part in an investor's portfolio because of these features. My feeling is that even AIF industry on the credit side will take off. There is more flexibility in terms of what you can invest into. Most AIFs are close-ended, so there's no redemption facility, there's no liquidity pressure. So my feeling is that AIF will go on the credit side, debt mutual funds will go more on the duration side, and combination of that will continue to play a role in investors' portfolio. For all the HNIs, my recommendation will be please look at equity savings scheme. These are the funds which have, limited exposure to equity and balances in debt, and they have equity fund status, so taxation wise it is far more better than the pure debt fund. So for HNIs, equity savings schemes or debt mutual funds or AIF for retail equity savings schemes will be very, very appropriate for the debt exposure.
Right. Now coming to equity, the last few years, especially post-COVID, have been extremely healthy as far as earnings growth have been concerned. And that has kind of given some kind of cushion from a valuation standpoint. India has also come off in terms of corrections. Going forward in terms of both earnings growth as well as sectors, where do you see growth?
So the earnings growth will be driven more by banking, automobile, telecom kind of sector. Some of the small cap companies which have kind of stagnated on their profit growth could also start delivering now. Overall, I still think earnings growth will be little lesser than what market is expecting. Market today is expecting somewhere around 1100 to 1150 Nifty EPS for FY25. Our guess is that we will be probably somewhere around 1050 to 1100. That earning growth is going to provide floor to our market. More importantly, it's not just 1 or 2 years earnings growth which investors are looking. People are looking at 5-year, 10-year earnings growth. And where else other than India you are going to get that steady line?
Absolutely. And in the current context, would you prefer more multi-cap oriented strategies or more, do you see selective opportunities in mid and small cap as well?
So almost for last 5-6 years, small cap haven't delivered any return from their highs. Valuations have become reasonable. And my feeling is that there could be turnaround in small and mid cap. So our recommendation right now, this is fair value market, so be equal weight to equity. Within that, be marginally overweight large cap and be marginally underweight small and mid cap. And that call has already worked out. Now is the time to buy small and mid cap on correction. Maybe over next 6 to 12 months, you should be overweight small and mid cap and underweight large cap, assuming that your allocation to equity will remain neutral.
Right. And finally, the asset class of gold. Now, it has been the best performing asset class, beating even equity in the last year or so. People consider it to be a hedge in the portfolio, and that is what it has done historically. But from a price standpoint, it's also moved significantly. So people are now skeptical. How do you recommend gold in client portfolios?
So while investing into gold, do remember that rupee gold includes 18% tax incidence, import duty plus GST. We can't sustain import duty at this level because it will otherwise encourage gold smuggling and other criminal activities. My feeling is that over next year or so, import duty may come down, and that will have an impact on rupee gold prices. Subject to that caveat, I am reasonably bullish on gold. All the central bankers of the world will be investing into gold and other precious metal. On the day of Ukraine invasion, Russia had 650 billion of reserve. On the end of the day, they were left with $150 billion reserve, which was lying in gold with them. The $500 billion of securities in US, Europe, Japan, UK got frozen. I don't think so any central banker after that experience is going to keep everything in securities. They are all going to keep something in gold. China's gold reserves will be about 2,000 tons. US is at 9,000 tons. Imagine if China continues to build their FX reserves to that level. So overall, I think central bank buying will support gold. If Fed cuts interest rate, gold prices will get supported. So from a dollar price point of view, I think gold will deliver decent return to the investors. But be aware that in rupee terms, as in when import duty comes down, there will be impact on prices.
Thank you so much, Nilesh Bhai, for your time. Always a
Thank you.
pleasure. Thank you.